Welcome to our latest podcast. I'm Derek Barrow from Santander Asset Management. I'm joined today by our Global Head of Macro, Tactical Asset Allocation and Alpha, Haydn Davies. Good afternoon, Haydn.
Good afternoon.
Okay, so UK inflation has not been falling as quickly as hoped. The Bank of England has been forced to raise interest rates for the 13th time in a row. How worrying is the outlook for UK inflation, and what does this mean for interest rates?
Well, I wouldn't say that the outlook for inflation is worrying, but certainly how UK inflation has been behaving has been disappointing. So there are reasons to be fairly optimistic about the outlook over the course of the rest of the year. But it is still obviously the case that UK inflation has, whilst it's falling, has been falling disappointingly slowly. And it's also the case that compared to most other markets, UK inflation is is very high, certainly high by the standards of the countries we'd want to compare ourselves against. So UK inflation is very close to 9%. US inflation is 4%. Eurozone inflation has fallen to 5.5%. So certainly the UK looks like an outlier. And whilst inflation is falling, yes, it's been falling disappointingly slowly. It's certainly true that UK inflation peaked, I think, last November. But yes, it's only really starting to happen very slowly now that inflation is coming down. But there are reasons to be optimistic, or at least more cheerful, on the outlook for inflation over the remainder of this year. So one of those reasons, of course, is that the new price cap has come in on UK household energy bills. So that will mean that inflation is falling. And of course, the reason for this is because natural gas prices have fallen quite sharply since the onset of the Ukrainian war. So that's good news for households. It's also the case that petrol is a lot cheaper than it used to be. So I think the price of a litre is now £1.40 compared to £1.90 last April. And if petrol prices stay where they are, that will mean that energy prices in general will not just be having less of an effect in boosting inflation, they'll actually be dragging the inflation rate down. In other words, they'll be deflationary. So energy prices should be falling. And that's also good news for the outlook for food prices. Obviously, food inflation's attracted a lot of headlines recently. Headline inflation for food just hit a recent peak of 15%. But for example, natural gas is an important feedstock into fertilizer production. And because natural gas prices have fallen, fertilizer prices have fallen, and they peaked last summer, and they've fallen quite sharply since then. That should mean lower food prices, not in the next month or so, because of the lags involved, but certainly as we look later on in the year and the like. So there are a lot of reasons to be a little bit more cheerful about the outlook for inflation. And perhaps one last reason is factory gate prices, factory gate inflation. So when we talk about inflation, we're talking about consumer price inflation. That's the prices you get online or in the shops. We can also measure inflation for goods leaving the factory gate. So this is earlier on in the supply chain. And that's called producer price inflation. And producer price inflation is running at a rate of about 2.9% and has fallen quite sharply again from about a peak of 15% about eight or so months ago. So that tends to lead consumer inflation by 4 to 6 months. So that again is another indicator that suggests that headline inflation, currently 8.7% in the UK, should fall quite sharply. Now, it's not all good news, of course. So UK inflation is high by international standards. It's expected to fall to around about 4% by the end of the year. There are two problems really, and this is what's concerning the Bank of England, and that is core inflation. So that is inflation ignoring what's going to happen to food prices and energy prices because they're quite volatile. So policymakers tend to think that core inflation is perhaps a better guide to the underlying trend. And the other problem is wage inflation. So wage inflation in the UK is around about, I think, 5-6%. And the problem here is that, as I think has attracted a lot of headlines, that there is a shortage of workers. So some people have left the workforce because of ill health or retirement. And of course, the UK is finding it harder to recruit workers from overseas as well. And so the bank is really worried about wage inflation. It is very high. It's high also in the Eurozone, for example, but it's higher here. The UK is an outlier again. And so that's what the Bank of England is keeping an eye on. And so it looks as if the Bank of England will have to raise interest rates another 50 basis points. And whereas maybe elsewhere central banks are close to the peak in interest rates, the Bank of England is probably likely to be raising interest rates well into the autumn. Now, if we are lucky and inflation starts to surprise on the downside, and there are reasons to hope that might be the case, then it may well be that the Bank of England, when it meets in September, it will have had 3 inflation readings before then, won't feel the need to be quite so aggressive in raising interest rates. But certainly for the moment, it's very hard for the Bank of England to call it a day when core inflation is still so high and when wage inflation is still pretty disappointing. The Bank of England wants to make sure that the labour market gets the message that it needs to bring down inflation, and wage rises of 6-7% are just not consistent with its 2% inflation target. So to summarise, there is more interest rate rises to come, but there are lots of good reasons to think that headline inflation will fall quite noticeably in the second half of the year. And that ought to be good news for Rishi Sunak too, of course, who's promised to halve inflation over the course of this year. That should actually happen, but of course he won't actually have had to do anything himself to bring it about, which I guess is one of the best promises you can make, a promise where something happens without you actually having to do anything about it. So some better news on inflation, but still some more interest rate rises to come.
Okay, thank you. So unlike the Bank of England, the US Federal Reserve left interest rates unchanged at its most recent meeting, but it did indicate it wasn't finished yet and expected to hike rates further. How much further could US interest rates go? And if the Federal Reserve is close to calling it a day, how long before it can begin to cut interest rates?
Yes, it was quite interesting that the Federal Reserve at its last meeting decided not to raise interest rates, but then indicated it was still worried about the inflationary outlook and pretty much promised it would raise interest rates at its next meeting. So that's quite an unusual mixed message to send. And the reason behind that really was the Federal Reserve is still worried about the impact of the turbulence in the US banking sector earlier in the spring. So we had the collapse of Silicon Valley Bank, Signature Bank, First Republic Bank. And it is worried that the tightening in credit conditions that we're going to see as a result of sort of the ramifications of that turmoil is going to have the impact of essentially tightening interest rate policy without the Federal Reserve actually having to tighten policy itself. So it'll have the same impact as the Federal Reserve raising interest rates. So that's really the reason why the Federal Reserve decided to pause and sort of take a breather and reflect and try to see if there's more evidence of what was happening in the banking sector, and if indeed tighter credit conditions, were starting to have more of an impact on the economy. Now, the reason the Federal Reserve said, well, we need to raise interest rates again is that whereas inflation has fallen to 4% in the US, it is still the case that core inflation, underlying inflation, ignoring the impact of food and energy prices, is at a worrying 5.3%. And wage inflation too is uncomfortably high. And so the Federal Reserve wants to see underlying inflationary pressures weaken a lot. And it's difficult for wage inflation to cool when you have such a hot labour market, which is still the case in the US, of course. But it certainly looks as if we are close to the peak in interest rates. The market is a little bit more convinced that that is the case. And in fact, the money markets are pricing in, I think, one more rise for sure, and the possibility of another rise after this. And that's because generally inflation is expected to fall over the course of this year. It should reach about 3% by the end of the year in the US, so much closer to the Federal Reserve's target of 2%. And so that suggests that the Federal Reserve doesn't need to do so much. And indeed, there's an interesting debate amongst economists and policymakers at the moment, really about whether it's worth squeezing the economy so hard at the moment just to get inflation down from probably 3% by the end of the year to 2% next year. So getting down from 3 to 2 is harder than bringing inflation down from 8.5 to 3.5, for example. And at the end of last month, we even had the deputy head of the International Monetary Fund suggest that maybe central bankers in the US in particular might not want to squeeze the economy so much just in order to get inflation down from 3 to 2% and to their target, that the cost was too high, the pain was going to be too much and it wouldn't be worth it. Now, central bankers, the Federal Reserve, have been pushing back against that notion. They certainly don't want people to think that their new inflation target is 3% rather than 2%, because if they think that, then people, when they're asking for a pay rise, will be saying, well, I expect inflation to be closer to 3% than 2%, so I'm going to ask for a higher pay rise than I otherwise would have done, for example. So policymakers are pushing back against that notion of living with higher inflation for longer. And what they're saying is, of course, that they're going to keep interest rates at elevated levels, higher for longer. So certainly that they're close to the peak in interest rates, but the sort of the cost going forward is that you shouldn't expect interest rates to fall anytime soon. And that is because central bankers and the US Federal Reserve need to squeeze the sort of last elements of inflation out of the system so that people expect it to meet its 2% inflation target in the long run. And that helps to anchor price expectations by firms and by consumers. So the message there is, whilst it's certainly the case that the US Federal Reserve should probably be raising rates only one more time, possibly two, but we are at the peak in the interest rate cycle from that perspective. But don't start to expect cuts anytime soon. We are really going to be living with higher rates for longer. And of course, really, we've just got interest rates back to where they were in the 2000s. And it's the 2010s that really were the anachronism. And so probably the message for investors is that you should expect interest rates at these levels, or maybe a little bit lower, over the next 5 years. And you shouldn't be expecting interest rates to return to the levels that we saw, well, even 2 or 3 years ago.
Excellent. Thank you, Haydn. So with inflation remaining so stubborn, how have we positioned our portfolios? And what do you think the main risks are over the remainder of the summer?
Well, certainly in terms of the risks over the summer, I would say that one of the risks is the inflation, and the fact that inflation either falls much more quickly than people are expecting, having been so stubborn for so long. And that's true in the UK, it's true in the Eurozone, it's true in the US. US inflation peaked last June, and it took a good few months for it to start falling noticeably. And that's been the case in the UK, and it's also true in the Eurozone. And now that energy prices, petrol prices, oil prices, natural gas prices are noticeably lower than they were, that's going to bring inflation down even more quickly. So one risk is that inflation starts to behave a lot better. Another risk, of course, is that we see oil prices move higher, natural gas prices start to rise higher in anticipation of the winter, and that pushes up inflation too. So that's going to be a key risk over the summer. Obviously, the war in Ukraine and the situation in Russia is a risk either way. If Ukraine starts to make huge territorial gains, there are obviously concerns about what Russia might do in response. So even that wouldn't necessarily be good news. So those are the main risks, I think, over the summer. And the summer usually isn't a good a good period for equity markets, I should say. And it tends to be quite a good period for bond markets. In terms of how we are positioned, I suppose we're a little bit boring. So we think that equity markets are reasonable at these levels. So we think that they're not expensive. The US is a bit expensive, but certainly Europe isn't. So equity markets are fairly valued, and the growth outlook, whilst it's not very exciting, the outlook is essentially for fairly meager growth in the second half of this year and even through most of next year. That's probably good enough to keep pushing equity markets generally a little bit higher, not spectacularly so, but it should push equity markets a little bit higher. That really the danger would be if we started to see the recovery that we've seen in growth from the autumn and the winter in the Eurozone and the UK, for example, that start to peter out. And certainly it looks as if the US economy could well contract either in the third or the fourth quarter this year, probably the third quarter, but then bounce back a little bit. But the outlook is for pretty weak growth. But if the outlook starts to deteriorate and that weak growth starts to look as if it's going to be very weak growth, then that would derail equity markets. So we are neutral in equity markets at the moment, but we'll certainly be watching out for more evidence that perhaps particularly the US is cooling more than expected, and the sort of credit conditions tightening is having more of an impact, and that the recovery in Europe is faltering, which certainly looks like the case at the moment. So that would be what we're looking out for. In terms of bonds, we're a lot more positive. And in particular, we're quite positive on the outlook for credit markets. So we prefer to take the extra risk, the extra spread you can take on credit as opposed to government bonds. So with interest rates peaking, less so in the UK, but certainly in most markets, that's generally a positive environment to take on bonds. And as long as there isn't a recession, the outlook for credit looks quite good too, because company balance sheets are in very, very rude health. It's the government balance sheet that's in poor condition, but generally companies are pretty healthy. So only if we saw a marked contraction would credit start to become more of a concern. So at these levels, at these spreads over government bonds, we think it's worth taking the risk. And so we're quite overweight bonds and credit in particular, and underweight cash at the moment. And so, yeah, in terms of the interest rate outlook, that's encouraging, certainly for bonds in general. But we don't think that if you don't buy today, you've missed your opportunity. So we are adding to positions. We've been saying this for a few months. We expect sort of bonds to be range bound. And if you don't buy today, you'll still be able to get attractive prices in a couple of months' time. And that's still the message that we're sending. So we're gradually building positions. It's not like we're jumping in trying to get the best price that's on offer at the moment, because we think that it will still be the case that bonds will be attractively priced in a month or two's time.
Excellent. Thank you, Haydn, for such a detailed update. So thank you once again for listening to our latest podcast. The views expressed in this podcast are the views and opinions of Santander Asset Management UK and do not constitute investment or financial advice. If you want to explore more of our views and insights, please visit our website at santanderassetmanagement.co.uk. If you require guidance or advice, we would recommend you contact your professional financial advisor. Thank you once again for listening to our podcast, and we look forward to speaking to you again soon.